Hello and welcome to the Zawya Podcast. I'm Imogen Lillywhite and today I'm talking to Rupert Connor, Financial Planning Advisor from Abacus. We've seen a lot of market volatility recently and that can lead to confusion about what we should be doing with our finances. So we're going to be talking through some financial planning principles today. Hello and welcome to the podcast, Rupert.
Hi Imogen, it's a pleasure to be here and thank you very much for having me.
We've seen some very advantageous exchange rates for UK expats who are remitting money back to the UK at the moment, thanks to the strong dollar and the weak pound, of course. But where should they be sending their money? What should they be doing with it in the UK? Perhaps you could talk a little bit about if they're making a long-term investment, because short-term is looking a little bit risky right now.
The only safe bet really in terms of investments are deposit accounts. Once you get past deposit rates, there's risk involved in that. So we spend a lot of our time talking to clients about risk and what that means and trying to explain that to them. So at the moment, a lot of people obviously sending money, they've got dollars because they're earning in dirhams here and they're sending that back to the UK. So there's two sides to that. The first one is if you're sending it back because one day you're going to live in the UK and spend those pounds, that's great, and by all means do that. Now's a great time to do it. But if I hear lots of rumours about people taking out debt, taking out loans in the UAE to then convert that money into pounds. So that's trying to make a fast buck as it were. The problem is you might be paying 6 or 7% interest on the loan here. You've got the spread the bank's is gonna charge. You've got FX fees. So when it comes to it, and if inflation keeps going up, things turn the other way. You're going to be stuck with this loan here, paying quite high fees.
So what people are trying to do, when I've not heard that personally, that they're trying to take out a loan to send it back. So what they're trying to do is do a very small version of playing the currency market.
Yeah, precisely.
Thinking that they've suddenly become a currency broker because of this thing.
Yeah, so it can be quite dangerous. And the days of $2 to every pound, I think those days are long gone. Do I think we're going to get up to sort of 1.4, 1.5 again? Is that feasible? Probably, but actually, parity or close to parity is probably where we're going to be with the dollar for some time now. So there's nothing to say that it might fall even further based on what's going on with the government at the moment. So if you are from the UK and you are planning on going back to live in the UK one day, then it makes absolute sense to be sending pounds back there at the moment. But obviously you are then sending money into a taxable environment from a non-taxable environment. So that's something else to consider. In terms of the UK as a hotspot for investment, in the short to medium term, it's probably going to be pretty volatile. But do I think over the in the longer term is the UK a safe bet? Yeah, absolutely.
Okay, moving away from the UK, much as we could talk about that for a very long time. Where are the wise investments going elsewhere? So if I came to you and said, Rupert, I've got $100,000 in my bank account, where should I be investing it? What would you say?
So we're sort of talking about the general theme of global uncertainty. So I would say that the importance of planning, sitting down and planning, comes into play. And reviewing where you are and what provisions you currently have, what you're likely to need in the short to medium term, and planning ahead to make sure you're not hit by one of the many hurricanes that could potentially blow through your back garden in that period. So we don't give advice we don't chase performance, chase the next best thing, the next investment. We sort of go by the diversification theory. So most returns, they say that 90% of returns come from being diversified. So myself as a financial planner, I'm not an economist or a fund manager. We actually do the financial planning, how it's underwritten, what's under the bonnet. We actually outsource the management of our clients' money to experts. And those experts, they're usually a team of sort of 500 people. They manage 20 billion of pension and charity money. So all they're doing all day is building portfolios. So within that portfolio, there'll be an allocation across the globe to different assets. So So some to the UK, some to the US, some to emerging markets, some to the Far East, Japan. And then it's rebalanced on a probably monthly basis. Because all markets tend to perform differently at different times. So if you're diversified across a truly globally, a global portfolio, you mitigate the chance for. I tell my clients if you want to go into crypto or you want to go and buy that beach bar in Bali, then you don't need to pay me to do that. You can just go and do that. You can go on Google now, set up an account and buy some crypto. You can go and there's all that fintech there. So we actually offer sort of tangible advice. So all the elements in our portfolios, they're real. They're hopefully in growth assets. They're in companies that everyone's heard of, household names that over the long term, should perform.
Okay, so last question. What to do if the worst happens? There's a lot of talk of recession in the air, not necessarily in the GCC, but we're seeing, say, European countries are tipping over into that. In the event of, say, things like job losses related to a recession, how should people think about getting their investments in order to prepare for it? What's the best thing to do?
Okay, so as I was saying earlier, the short to medium needs should have a much sharper focus. We all need to be prepared. So if you're prepared, then that presents great opportunity for long-term planning, i.e. planning properly gives you clarity that you'll be able to live through anything in the next 5 years, even from a full recession. So the first thing I would say to anyone is reviewing debt, basically. So in any financial plan, high interest debt has got to be the first thing to go, basically. So you've got to try and pay that off. Then you can look at if you've got any existing mortgages. So most people have been on a fixed mortgage for some time now. So trying to shop around for a deal, maybe a variable rate. But yeah, personal loans, credit cards, student loans. Got to get rid of that high interest debt first. Insurance review, so shopping around for better deals on things like home insurance and car insurance. It's always if someone's got any debt or they've got children, it's probably healthy to have some life cover in place for that. It's probably the responsible thing to do for that. And then you've got the sort of cornerstone of financial planning, but budgeting. So now is the time really to batten down the hatches, and I would say don't be taking on any new debt. Don't be having 4 luxury holidays a year, maybe 1 if you can. Don't be buying new cars, your weekend Porsche. Like all those things just need to go, because with the cost of living going up, at some point it's probably going to catch up with the United Arab Emirates, and with rents have gone up 33% this year. Property in the UAE has gone up 33%. So it's an expensive time to be living in Dubai at the moment. So reviewing your household spending could be one of them. Reviewing your auto payments and subscriptions. So Netflix, all those subscriptions we pay on a monthly basis. Do we need them all? That might have been something that people looked at during the pandemic. I know I certainly cut down on a few things, but maybe they've crept up again since then. The last thing that people sort of tend to do is if they're making a sort of pension contribution every month or a monthly saving, they tend to just stop that. But actually, you've got to try and keep that going. That's got to be one of those expenses in your mind, like a mortgage that you keep on paying every month. You might have to reduce it, the amount that you're putting in each month, or maybe put it on hold for 3 months. But when markets are like this, so if you can contribute on a monthly basis, over the long term, do I think markets will recover at some point? Well, hopefully they will do. So I think it's always important to keep on contributing, and you've got to remember what you're trying to do. Why are you working so hard? Well, you're working hard so your kids you can look after your children, so you can retire one day. So that hasn't changed. It doesn't matter what the markets are doing. So as long as you're invested sensibly and wisely, and hopefully you've taken advice on that, it doesn't really matter what's going on there. So as long as you've protected your children on premature death, so they're looked after, or you've hopefully taken advice on your pensions, where it's invested, the beneficiaries are all sorted, the things like that are checked, then you can rest easy knowing that in 30 years time you're going to have you're going to be comfortable in retirement. So that's the name of the game, really. We're all trying to save a pot of money that we can use when we're 65 to draw out of, but hopefully by then has had some decent growth.
I think you hit on something interesting there, that people, I think, do stop paying into pensions when that happens. But obviously you're going to say don't do that as a financial advisor. But I think it's very easy to panic in that situation and make decisions that aren't necessarily so great for the future. And once you've stopped doing it, I think we all know that it's hard to get back into it.
So I think over the pandemic there were lots of banks were offering 3 months, weren't they, on car loans and 3 months off on bank loans and things like that. But it's definitely important to keep contributing.
Okay, I think we'll leave it there. Thanks so much for coming. You've been listening to the Zawya Podcast.